How do I limit losses in Forex trading? Hi guys, welcome back to the channel. If you are new, please consider subscribing so that you do not miss future videos. Please like this video. Uh, like this video to motivate me to continue sharing all this knowledge with you for free. Everything that we do here is for free. If you are looking to download stuff, forex robots, forex books, indicators, and stuff like that that you need for your trading, there are links in the description box below. Visit those blogs and see if you cannot find what you are looking for. If you're looking for a broker, my broker, the links are in the description box below. I've never had problems with them, so I try to recommend the same people that I use. So let's get into today's video. How do you limit losses in forex trading? How to limit losses in forex? So there are many ways that you can do this. By the way, if you have your own method that you'd like to share, please please leave a comment in the comment section below. Of course, I would like to hear how you manage losses or limit losses in your day-to-day trading. Okay, so the first thing that you would want to do is you must know your risk to reward ratio. In other words, how much are you willing to lose per trade? And you compare that to how much you are expecting to make on that trade. You need, before you click buy, before you click sell, you need to know first what's my risk to reward ratio. Most traders avoid a risk to reward ratio of 1:1 or 1:2. Basically, if you are entering a trade with the potential to lose $1 to make another dollar, that's not a good trade, because if turns against you, you are in a loss quickly, just like that. At least so okay, it's well, 1:2, you already understand the math. If you're risking $1 to make $2, uh the one of the most famous traders, Paul Tudor Jones, uses a risk reward ratio, or used a reward ratio of 1:5. 1:5. So if a trader, if he's risking $1, he expects to make on that trade $5. You understand the risk to reward that's there. So understand risk to reward before you place any trades. Number two, stop losses. This is obvious. It's a useful way to prevent losses. It's a useful way to prevent losses. So ideally, you want to place them around 20 pips or so, 30 pips. It depends with the dynamics in the market, because sometimes 20 pips, 30 pips is too little, and sometimes you get stopped out. So you need to understand the dynamics of what's happening in the markets at that time. Then you place your stop loss. If you're buying, certainly below the support. If you are selling, certainly above the demand zone or the resistance, whatever you call it. And yeah, you might still get your stop loss hit, but that's the purpose of the stop loss. And when your trades get into profit, then you also need to start looking at how to trail the stop loss. That's how you are trying to limit what losses in your trading, so that when the price goes in your favor, your trailing stop goes in and what secures the cash. Okay, number three, what you want to do is have a thorough trading strategy. And you actually stick to it. Most people have the most amazing trading plans, most amazing trading strategies. But the problem that you are making losses is you do not follow that strategy. It's just there. It's just there. For some reason, people come up with fantastic trading ideas, fantastic trading plans, what to do, what not to do, when to enter, when to get out, and stuff like that. But you find that people, they don't follow their trading strategies, they don't follow their trading plans. That's how you make losses. So have a trading strategy, have a trading plan, and actually stick to it. That's how you limit losses. Um, Number four, keep your trading plan simple. Yes, related to the previous point, most of the time we think complex is okay. It means I'm going to make money, I'm going to confuse the market, I'm going to confuse everyone around me. But what he end up doing is basically just to confuse you. uh, Try to have a simple trading plan, a simple trading strategy, which is easy to execute. You don't need to think too much to look at that indicator, to look for this, to look for that shape, to look for that color, to look for this pattern, to look for this ribbon. Have a simple trading plan, trading strategy that you can simply you can glance at it, and you can easily tell whether you need to get in or to get out. The reason people lose money in trading is sometimes people try to complicate things for no reason. Okay, the next point is understand how much you are risking, with related to the first point about knowing your risk to reward. Understand, for example, you have $1,000 in your account. You need to determine how much you are going to bet for any trade. I know the common encouragement is that only risk 2% of your account per trade. Some people tell you 5%, some people up to 10%, but I leave it up to you to think about how much of your account you need to risk per trade. The thing is, how people lose money is sometimes they are risking 2% on a winning trade, and then they risk 10% on a losing trade, which does not make sense whatsoever. So, in order for you and your trading account to last longer in the trading markets, you need to have an idea of how much you are risking. Some people recommend 1%, some people say 2%, some people say 5%. Determine which one works for you, but have an idea of what you are risking per trade. I think number five, what you want to also do is look at your leverage. Leverage is a good thing because you can easily make money, but most people will forget that it's a double-edged sword. The more you put on your leverage, whether you choose 1 is to 500, 1 is to 300, 1 is to 50, 1 is to 800, it can greatly boost your account, or you can quickly lose your account. So if you are not understanding what you're doing, reduce your leverage. If you are on a losing streak, reduce your leverage. Your leverage is one of the reasons why you are losing money in trading. I think number six. Now, here's what people do when they are trading and they are making wins. They don't compound their wins, they actually do the opposite. They compound their losses. If a person enters a trade and is losing money, you find that that person starts adding more trades to that losing trade. they end up blowing their account. So don't double down when you are taking losses. Don't increase the losses. Don't increase the losses. Take a loss, walk away, go and clear your mind, come back the next day and try again. Don't compound your losses. If anything, you're wanting to compound anything, compound your wins. Okay. I think number 7, it's important, it's an extra. Be extra careful when you're on a winning streak. It all happens to us, it happens to many of us. You are suddenly on a winning streak and you're feeling confident and you are happy, and you start feeling like you have mastered the markets. That's the common recipe for disaster. Because the moment you start feeling that you are the man who knows the market, it means that everything, your trading plan, it means that you are greedy, it means your risk reward, your everything goes out the window, because you are on a winning streak and you are feeling good, you are overconfident. Trust me, that's how many people actually lose money, because overconfidence usually just exposes you to so much risk. So don't try to be overconfident because you have won 10 out of 10 trades, 100 out of 100 trades. Just stay, keep your feet on the earth. Extra one, keep learning. Keep learning. The market is always evolving, so if you do not keep learning, you are always going to be losing money, because some things that worked many years ago no longer apply in the market. So the market is ever changing, so what you want to do is keep learning, keep refining your craft, and you certainly get there. Did I leave out a point? Leave it in the comment section below. Like this video, subscribe if you're not yet subscribed. Until next time, bye.